Welcome everyone. Today we're talking about how mortgages are not a scam. They are just simple math. And in this video, I'm going to show you how that's so. Now, whether you're one of my students or you're just trying to understand how mortgages work, you're going to leave this video fully understanding how it is that a mortgage works and what is essentially the math behind the mortgage. And don't worry, it's very simple math. Anybody who watches this is going to be able to walk away and fully understand their mortgage. All right, let's jump into it. Before we get started, if you're going to get any value out of this video, I ask that you give me a thumbs up. I would be eternally grateful to you. All right, so let's go ahead and get started here. So before we get started, we need to agree on two very important concepts. Number one is that there is a cost to borrow money. That's usually called interest payments. Okay, that's the first one. And the second one is that the larger the amount you borrow, the higher that cost is. So let's say that we're going to borrow a certain amount of money for 1 year. Okay, we're going to borrow $100 for 1 year. And we're going to pay a 5% interest on that money. How much do we need to pay additionally on top of the $100 that we borrowed? We need to pay $5. If we borrow $1,000, we would need to pay $50 in interest. If we borrowed $10,000, we would now need to pay $500 in interest. And $100,000, we would pay $5,000. And if we borrowed $1 million for a year at 5%, we should expect to pay $50,000 in pure interest. Of course, you're also going to pay back the original principal amount. Okay, so we can see that the higher the amount we borrow, the more we need to pay. It's more expensive, right? It's proportional to the amount we borrow. Now, one thing I want to do that might be kind of interesting is I want to put you in the lender's seat. So let's say that you are now the lender. You have some savings and you want to lend it out and you want a 5% return on your money. Let's say, for example, somebody asks you to borrow $10,000 and you tell them, I'll let you borrow $10,000, but at 5% for 1 year. What should you expect back at the end? Well, you're certainly going to want back your original $10,000 plus the $500 in interest. So in total, you should expect back $10,500. And that math works up and down this amount borrowed chain, okay? The reason I do that is sometimes when we think about mortgages, it's hard to put ourselves in the seat of the lender, but I hope that this will help as we go through this lecture. I guess that's what it is. Okay, so we're gonna watch a video of a TikTok video that I found that claims that mortgages are a scam. And we're gonna go through it. We may pause it and talk about it, and then we'll dissect why it is that they're wrong and why the mortgage is not a scam. So let's go through the video here.
What's a scam that's become so normalized that we don't even realize it's a scam anymore?
How your bank is charging you interest on your mortgage. Yep, that's right, I said it. For those of you who don't know, let's break it down in really simple terms. $1 million property, 20% deposit. So you put down $200,000, 30 years of mortgage on a 5% interest rate. And none of this property taxes or insurances. I've made it really simple. This is how much your monthly repayment will be, but that's not even the worst part. You're borrowing $800,000, but look at how much interest you're paying back to the bank. And that's not even the scam. Take a look at this example here. Look at the dark blue line and also the light blue. Take a look at your mortgage. For the first 15 to 20 years, you're paying down more interest than you are the principal. And I can't fathom how many people don't actually understand this. If we focus on this example again, $4,300 per month roughly equates to $50,000 per year. But of that $50,000, do you know about $40,000 of that is going to pure interest alone?
Okay, I want to pause it here. Remember what you said. When you borrow he's borrowing 800,000, right? He's borrowing 800,000. You're going to borrow that. Now, you're not paying it back for until 30 years, but you're using that 800,000 in the first year, right? And at 5%, 800,000 times 5% is equal to a cost of 40,000. Okay, that's how much it costs. Okay, now if you paid all $800,000 in a year, you would only pay $40,000 in interest, and you'd pay $800,000 back. But you're not. You're taking 30 years to do this. Okay, so there is something else that he said. The amount you pay in interest is much higher at the beginning than the amount you pay towards principal. And we're going to show why a little bit later. Let's continue this video.
Now, the scam here is, why can't the banks and lenders reverse how much interest that you're paying in the start of the year? Why can't you pay more principal than you are interest at the start? Why is it inversed?
Okay. He's saying, well, the banks are forcing you to pay all this interest up front. Why can't you pay more principal up front? Okay, we're going to talk about that. We're going to use some examples to show how this is not a scam. This is purely math. Okay, so let's keep going here.
I'll tell you why. There's a very simple explanation. On average, homeowners move homes or upgrade every 8 to 10 years, meaning you get to around this stage here, and then the whole cycle repeats all over again. And that's where the scam lies. If you don't...
All right. I have heard this from some friends that I have in the real estate business that, people typically move every 7 to 10 years, so they have to start this cycle back. And that is true. When you take out a mortgage, you are starting again from the beginning. I'm going to talk about how there are some ways to reduce the impact of this as we get through this lecture. All right, let's keep going here. So, firstly, let's talk about what is a mortgage. Now, a mortgage is typically, when we talk about mortgages, we're talking about housing, but a mortgage is a type of amortized loan, all right? So a few ways to define an amortized loan are that the payments are fixed throughout the duration of the loan from, month number 1 to, if it's a 30-year loan, month 360, the payment is exactly the same. It doesn't fluctuate, okay? Now, the payment is made up of two parts, the interest payment and the principal payment. The interest payment, this is the cost that you're paying to borrow that money, and the principal payment is the payment that it's used to pay down the actual balance of the debt. Now, some of you that may have mortgages are now saying, Israel, my mortgage fluctuates year to year, so I know that's not true. Let me address that. We're only talking about the loan portion of the mortgage. When you take out a mortgage, there are other elements such as tax, such as insurance, whether that's home insurance or whether that's mortgage insurance. They are all added together. When you pay your bank, you're paying your payment for the loan, you're paying your taxes, you're paying your insurance. And what happens as your home appreciates in value over the years, the amount of tax typically goes up. So it may fluctuate for that. One way to think about this is, for example, if you've ever bought a car or have a car note, you know that payment doesn't change for all, let's say, 60 or 72 months. But what might change year over year is the insurance rates on your car, right? So think of it that way. The amount that you're financing doesn't change, but what changes are these other elements such as tax and insurance. Okay? All right, I hope that was clear. Let's keep moving here. All right, so let's compare the 30-year versus the 15-year mortgage. Like I said, there are some elements of truth that we saw in this video. For example, what you have here, now his graph was inverse, but I don't like it that way. What we have here is in the red, in the beginning, this is how much we are paying in principal. Okay, this is what we're paying down on the outstanding loan. And in blue, that's how much is going towards interest payments. So yes, in the beginning, the interest is much higher. But look at what happens when we switch to a 15-year mortgage. Well, now the difference is much more even. Why? Why is that? Why is it that in a 15-year mortgage, we get a much more even split between how much we pay in interest versus principal? And the reason for that is that you're paying a lot more money every month for your mortgage or your amortized loan. So let's say, for example, in his example, I'm just going to keep it simple. They were paying $4,294 over 30 years. For a 15-year loan, that might actually be a payment of $6,500. I'm making that number up, but I'm just feeling through. I'm just trying to give you an idea, right? So the payment is substantially bigger, right? And so that's allowing this principal payment to be larger to pay down the loan faster. Therefore, your balance decreases quicker and you pay less in interest, okay? Don't worry, we're going to do some simple math that's going to show exactly what I'm talking about. All right, let's keep moving here. So the elements of the 30-year mortgage. Now this will work whether it's 30-year or 15-year. The only thing that changes is the number of years, okay? All right, so for a 30-year mortgage, we have a total of 360 payments. Of course, that's going to be 30 years times 12 months. That's 360 months. Now, one thing that a lot of people don't know is that the interest rate is, yes, it's fixed, but it's also fixed on a per month basis. A lot of people just think of the interest rate as 5% per year, okay? But because you are making payments every month, we actually take that 5%, divide it by 12, and find the rate, the interest rate that you're paying on the loan every single month. Now, in this case, 5% divided by 12 is 0.4167% per month. Now, this amount, that's what you pay on the outstanding balance. Okay, so every single month, it's not going to change. From January to December, for 360 payments for 30 years, you're going to be paying this amount every single month. This is fixed. It's contractual. That's what makes a mortgage an amortized loan. That's an element of it. So if you have $800,000 to start off with, in January, you're going to pay this percentage of it. Okay. And then you're going to pay down your debt a little bit. And so this number will begin to decrease. But what won't change is how much you're paying in interest every month. Okay. Don't worry. We're going to get to the numbers. All right, so I have an example here. The example is based off of the original video that we saw. The loan is $800,000, and look at this. The payments are the same every single month. This is going to be the same payment for 30 years, 360 months. Okay, so that doesn't change. It's fixed. So now, one thing I want to say is 5% is equal to 0.05. When you take 0.05 and divide it by 12, you end up with this number, which is technically the exact same thing here, but this is just represented as a percent. 0.4167 represented as a decimal is 0.004167. Okay? If you need to go back and listen to that a little bit slower, go ahead. All I'm saying is that we're converting 5% into a decimal and we're dividing by 12 so we can get the rate per month. Okay? All right, great. So we're going to grab our calculator here. We're going to do a little bit of math. Don't freak out on me. You guys can follow along. Any simple calculator will be able to do this. So we have our outstanding balance of $800,000. We're going to multiply that by 0.004167. Let me grab my calculator here. Okay. Now I already have that number saved, but we'll just do it. Let's do that. So we're gonna. Okay, it's not rounded. It's actually 0.004167. You just can't see the other numbers. So if you multiply this, and let's do the first one together. 0.004167 times the 800,000. Okay. That's a payment of $3,333.60. So $3,333.60. That's just interest. That's just the cost of borrowing this much money, okay, having an outstanding balance of that amount. Now, because the monthly payment doesn't change, it's fixed, that means that the principal is simply the difference between the interest payment and the total monthly payment, okay? Because this is fixed, there's only a certain amount that can go into here, okay? So now let's subtract that. Let's store that number here. We're gonna subtract. Here's my payment, and we're gonna subtract the interest amount that we calculated. Okay, and that's going to give us a principal payment of $1,590.97. $1,590.97. Now, you'll notice that if you add these two together, interest and principal, you'll get your total monthly payment. Okay, you'll get your total monthly payment. And that's what we want. Okay, that's what we want. Now, the principal payment, this amount here, this amount is what we use to reduce our balance. So we are now going to take this number away from 800,000, and that's going to give us our new balance at the beginning of the next month. Okay, so this amount, I'm going to store this number here. I'm going to take my 800,000 and I'm going to subtract the principal portion of our first payment. Okay, and that's going to give me $798,409.03. 798,409. 798,409. And what did we say? 3 cents? I think so. Yes. Okay. So you see, we reduced the balance by the principal amount. Now, in February, we're going to take our balance and we're going to pay the interest on this balance. So times 0.004167. And notice now our interest payment is slightly lower. This is $3,333.60. This is $3,326.97. So less by like $4. Okay, not that much because our balance is still really large. So 3,326.97, 3,326.97. Okay, and the monthly payment is fixed. So I'm just going to find that difference for you really quick. Okay, 1597.59. We're going to round this to 60. 1597.60. 1597.60. So notice we were paying an additional $7 here. We should also be paying less $7. So 26 for, yep, about $7. Okay, right. So let's say that time passes. Let's say that 15 years passes, and now your balance is down to 400,000. Okay, we're still going to multiply that 400,000 times the interest per month. Let's do that. 400,000. I'm just doing this to prove a point. 0.004167. Look at the interest payment now. $1,666.80. $1,666.80. Okay, it's substantially less. All right, let's say that a total of, let's say 15 years passed. Let's say 15 years from one to the other, right? You're halfway there. Okay, but look at what happens to the interest payment. It gets cut in almost half. And then what does that mean about the principal payment? That means that the principal payment needs to be almost double, right? Let's see if our math is right. Okay, we're going to subtract that from our payment. And forget about the negative. $3,257.70. $3,257.70. So now we're paying a lot more in principal, but it's purely because our outstanding balance has gone down significantly. So therefore, the interest payment has gone down, which means that the principal payment must go up because the monthly payment is fixed. Okay. Now, the creator of this video says, why can't the banks? It's like a scam, right? Like, why can't the banks just flip this? Well, look what's happening here. If we flip this, right? If we made the interest payment $1,590, then the math that we have here, the 800,000 times 5% divided by 12, doesn't work anymore, right? So you're not paying the correct interest amount every month. That's why it can't be flipped, right? There's no mathematical basis. The banks are not trying to force you to pay all your interest first so you have a bunch of principal to repay. What they're doing is they're charging you that cost of the balance, every month. So as the balance declines, right, you pay less in interest, you pay more towards the principal, your balance declines more, and then so on and so forth. Now, a lot of people claim if you pay more in the principal payment, you can pay off your loan quicker. That is 100% true. So what can you do here? Now, you're obligated contractually to pay this amount every single month for 360 months. But there is nothing stopping you from doing an additional principal payment. So let's say, for example, that you wanted to pay an additional amount of plus $500. Okay, let's say you're committed to making that additional payment of $500. So not only are you going to pay your required amount here, $1,590, you're also going to add $500 to the principal. So that means that this amount here gets reduced, and therefore the interest payment gets reduced and the principal payment gets increased. You pay another $500. So this effect, that $500 has a chain effect all the way through the length or the life of that mortgage. Okay. And if you can consistently make that payment on a monthly basis, then you will really see the effects in the long run. Now, I don't have the numbers off the top of my head. You could make a certain amount of payments and cut the lifespan of the 30-year mortgage easily by 5 years, 8 years, 10 years, depending on this amount here. If you guys want to understand that a little bit better with the spreadsheet, I could totally make a video, but leave me a comment and I'd be happy to do that. So I know that a lot of people, what they say is, I make one extra mortgage payment a year. So if you're making one extra mortgage payment, look at this, $4,924 to principal, you're directly reducing the outstanding balance, which reduces your interest payment, which increases your principal amount that you contribute every month. And it affects the whole life of that loan, and you get to pay it off quicker. Okay? All right. I know this is a little bit of a mess. I hope that was clear. If anything was not clear, please leave me a comment. I'm more than happy to talk about this. This is my bread and butter. So let's keep going. And I think all we have now is an example of a different creator. And I found her example really fascinating because she gives us a lot of detail and we can really dissect what she's talking about. And hers is sort of she's going through her real experience of taking out a loan. So why don't we go ahead?
So my husband and I refinanced our mortgage today because interest rates dropped and it was enough to save us $300 a month. However, I have in my hands the amortization schedule, which is how long it's going to take us to pay off said mortgage and how much would go towards principal and interest each month. And I want to use this to talk to you about why home buying in America is an absolute fucking scam and why this will be the last house we ever buy in this country. So just really quick facts, is a standard 30-year.
I just want to point out that it doesn't matter whether you buy a house in this country, in another country, money is money. And the way money is lent is typically going to be the same. If you get a mortgage, which is an amortized loan, it's going to be the same no matter where you go on this planet.
mortgage. It's a VA loan, so I didn't have to put anything down in order to refinance, and I don't have to pay any mortgage insurance, which is what normal people have to pay when they don't put 20% down. But because we didn't put anything down, I went from owing $784,000 on my home back up to $795,000. But
Okay, so here she says she's going from owing $784,000 to $795,000. So she's actually increasing the size of her loan. This looks like there was some sort of cash payout of approximately $11,000 for some reason. She doesn't explain that, but she's basically making her loan larger and starting over on the loan.
Original interest rate on this house was 6.2%, and now it is 5.6%. We are planning on selling this house when my husband retires in 4 years and exiting the U.S.
Sorry, I need to see what. She went from 6.2 to 5. What did she do?
Now it is 5.6%.
5.6%. So, I mean, though that's only really 0.6%. To refinance for such a small change in your interest rate, she's saving $300 a month, but usually I would typically wait to see a much bigger gap to refinance because there are costs to refinancing.
We are planning on selling this house when my husband retires in 4 years and exiting the U.S. So, of course, I was interested to see what will I owe at that time in 2030. And at that point in 2030, we will owe just under $750,000. So I will only have paid off $50,000 worth of my mortgage in the next 4 years. But the math ain't mathin' because my payment is $5,700 a month. $5,700 a month times 50 payments is $285,000. And if you look at the schedule, it tells you, oh yeah, you're financing $795,000. But if you kept this interest rate over 30 years, you're actually going to end up paying $1.6 million. But the biggest scam of all is how much interest they charge you the first year you own the house. And I have other videos on this. I've talked about it. Again, I put myself in this situation. It is what it is. The point is I'm calling out the banks because they are fucking ridiculous. First of all, when you come to closing, we bought $7,000 to closing. They make you pay $3,500 in upfront interest. So not only are your first 12 payments horrendously just put towards interest, but then you have to bring extra money to closing just to pay interest upfront. Now, I will say this, our principal and interest amount is $4,500, and it's our taxes that are additional $1,000, which is how we get to that $5,700 number. Our first payment is 11/1 coming up, right? $4,500 payment, only $849 of that goes to principal. And every month after that, only $4 extra of your payments goes towards principal. My very first payment, $4,500 payment, $3,700 of that goes to interest. So even though over the next 12 months, I'm going to make roughly $54,000 in principal and interest payments, not including taxes, according to the amortization schedule, I won't even have paid down the mortgage a total of $10,000. And not for nothing. Again, remember, I was down to about $784,000 before I decided to refinance to save money. But 12 months from now, I'm going to owe the exact same amount of money on this house as I did yesterday before I refinanced. And so that just goes to say that refinancing is also a fucking scam. Because you claim that you're saving me money, but in the end, you always gonna get your money back. And while I get to cash out my escrow account from my previous mortgage and I don't have to pay my mortgage in all of October and you're handing me $14,000, you're literally just framing it like you're paying me in girl math. But in reality, I'm spending way more money with the bank. And because we want to sell the home in 4 years, it literally doesn't make sense for us to refinance again, because even if we did with an even lower interest rate, we wouldn't be able to recoup that because most of that first years of payments would go directly to interest. So the only thing that we can hope for now is that when we get our mortgage down $50,000 down to $747, and hope that we can sell our home for maybe $850, maybe, and hope we can, that doesn't even include realtor fees and things like that. Maybe we'll be able to sell our home and leave the US with $50,000 in our pocket. It is not worth it. Home buying in this country is an absolute scam. And I hate that the only other options are rent.
Okay. So part of the problem here is that she's not, she's taking out a loan for $795,000. So $795,000. And she has an interest rate of 5.6%. So as I showed you, we're going to take that 5.6% and we're going to divide that by 12 to get the monthly rate, right? So we're going to do 5.6 divided by 12. That's 0.4467% a month. But in decimals, it's, I didn't want to do that. So I'll just do it myself. 5.6 divided by 12 is 0.4467, 0.4467. But this is a percent. So the amount that she's going to have to pay in decimals is 0.004467. That's how much interest she's paying on the outstanding balance. Now, she told us that the payment is $4,500. That's how much she's paying every single month for the next 30 years, right? So we're just going to build the chart. We're just going to double check her numbers, right? So her total payment is $4,500. What we're going to do is we're going to take this balance and we're going to multiply it. Let's do that. So we're going to divide that by, we're going to actually turn it into a, you know what, let's just do it by hand. So don't confuse anyone. 0.4467 times 795,000. Okay, so she's paying, and what did she say? 3,700. I have her paying 3,551 in interest payment. 3,551.27. 551.27. So that means that her principal payment needs to be the difference between those two things. We're going to subtract 4,500. Okay, so $948 is what I have. So we might have a little bit of a different number, but that's okay. The point is to show she's paying a lot of interest because that outstanding balance is huge, right? Now, is it a scam? I mean, you're borrowing $795,000. There's a cost to borrow that money, right? Let's say that she had put down the 20%. Let's say she'd put down 20% to borrow this money. So how big is that loan? Let's do 795,000 times 0.8, because that means she put down 20%. That would be a loan of 636,000, right? 636,000. Let's keep the interest rate the same, right? That 0.00467. Let's see how much she would be paying in interest here. So 636, we're just doing the interest part, okay, times 0.004467. So she would be paying 2,841. 2,841. And just eyeballing it, that's a difference of $600 less because the balance is less. So look, is this a scam, or is this really just the fundamental understanding that when you take out a really large loan and you're taking it out for 30 years, that you're going to pay less in principal? You're going to pay less to pay down that loan because so much of it, because the balance is so large at the beginning, goes towards making interest payments. I don't really see that as a scam. The banks are not in this conspiracy to extract, to get money out of you and leave you with a large balance. It really just is the cost of borrowing a lot of money. You don't want to pay a lot in interest, then you need a larger down payment. And I know it's hard to get a larger down payment. In a lot of markets, 800,000 could be a base entry house. And I'm not saying I have the solutions to the housing issues. All I'm saying in this video is understand how a mortgage works. You notice that in this video, she said we didn't have to put down 20%. But had she put down 20%, at that interest rate, she could be making a bigger dent in her principal payment and paying off the house sooner. Okay, so of course, my purpose of making this video was to help you understand how a mortgage works, just the math behind it. There's no scam. The banks are not. They're not in a conspiracy to charge you as much interest up front. Interest is just a calculation of your outstanding balance. And that's it. If you take away anything from this video, it's that. It's that the amount you pay in interest is just a calculation of how big your balance is. Okay? And if you have a fixed payment, well, that means that the difference is your principal, so it needs to be smaller. Now, could she have done a 15-year loan? Yes, but her payment of $4,500 very likely would have gone up to $6,500. There is a way for me to find out exactly how much. I'm going to grab my financial calculator here. Let's first look at her $795,000 loan here. So 360 payments. She has an interest rate of 5.6 per month. That's the per month amount. What she's borrowing is $795,000. We're going to pay that down to zero. So her payment is $4,563. So that's her exact payment. She told us $4,500. Okay. So let's say that she wanted to pay down this exact same loan, but in 15 years. So 15 times 12, it's 180 obviously, but we're going to put that in here. We're just changing it from 30 years to 15 years. Now look at the change in payment. Roughly $4,500 to $6,538. And she'd pay it off in 15 years. And she would be paying a lot more towards principal in the first year. I can actually even find out. We're going to second, and we're going to look at the amortization in the first month. The balance at the end of the first month is $792. Look what she's paying in principal, $2,882 versus $948, just from switching from 30 years to 15 years. And the interest is $3,710, very close to what we got, because the amount is the same. The amount outstanding is roughly the same. We're playing with some slightly different numbers because I don't think she's given us the exact amount, but that's okay. Notice the principal roughly stay the same, but you pay a lot more. The interest stays the same, but the principal goes up significantly. Instead of only paying $948, now you're paying $2,828, almost $2,000 more towards reducing the balance of the loan, and that'll make it fair, right? If you're concerned about, hey, why am I paying so much in interest and not enough in principal? Well, she could add an additional $2,000 to her principal payment, and that would reduce the life of the loan from 30 years to 15 years. Okay, guys. So remember, the takeaway here is the larger the balance, the larger you're going to pay in interest payments. Okay, I just want you to take away that from this video. I hope you got something out of this. This is probably the longest video I've ever made, but I think there was a true lesson in here. I'd love to hear your questions. Was I unclear? Could I have been clearer with anything else? Leave me your comments and your questions in the comment sections. I'll see you in the next video. Great. Bye.